Welcome to our first bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be diving straight in by going to bar area 1. This is section A1. This is an analysis topic, and it is compare current period financial statement accounts to prior periods or budget and explain variances, basically variance analysis. And we're going to be doing that today, doing the SuperfastCPA method, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. So make sure you check that out. And after you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to the full versions of these videos. In today's video, we're only going over 7 questions for the YouTube version, but SuperfastCPA Pro members will get access to the full 14-question video. Usually it's 5 questions for YouTube and 10 questions for members, but in today's video, again, it's 7 and 14. And again, if you like this and you like our other videos for the other sections, make sure you check out becoming a SuperfastCPA Pro member to get access to a lot of great stuff, including the full versions of these videos. Now, with all that said, let's dive straight into, again, our first bar video. All right, here we are at the first question. Let's just dive straight in. One thing that I always like to point out, and you'll see this in a lot of the other videos if you've seen the other sections, I like to point out a good strategy, which is to read the last sentence of the question first. Very frequently, that will give you an idea of what the question is about, so that you kind of have an idea of what you're getting into right from the start, instead of reading through the whole thing and maybe not knowing what you're supposed to do until the end. So again, read the last question first to get that context. What are the material price and material usage variances for March? So again, imagine you were on test day, you were at the exam center, and you saw this, and you immediately know you're dealing with variances, maybe material price and material usage variances. Okay, so we know that. So now let's go up to the top. Norwood Tools manufactures aluminum brackets. The standard cost of direct materials is $3.30 per pound, and each bracket requires 1.5 pounds of material. In March, Norwood produced 2,000 brackets. The company purchased 3,400 pounds of material for $10,880 and used 3,080 pounds in production. So again, based on all these numbers, what is the material price and the material usage variances? It's 2 different things. Now, if you know how to do this, that's fantastic. But if not, we're going to be using this explanation and the explanations throughout this video to learn how to calculate different types of variances. So if you want to give this a try, that's great. Maybe pause the video and do that. But if not, if you have no idea what you're doing, that's okay. We're going to look at the explanation together right now. All right, here we are. The answer is B. There's a $340 favorable price variance and a $264 unfavorable usage variance. So we're going to learn about, again, 2 different kinds of variances. And just letting you know, this is going to be kind of a packed video. There's only 7 questions that we're going over, but in each question, we're going over usually 2 different kinds of variances that are related to each other. So again, we're doing material price variance and material usage variance in this question. And a lot of the other questions will be similar where we do 2 different variances. So you're going to want to pay attention to how we do all these different calculations, take some notes, and you'll learn how to do this. So again, first, we're going to start with the material price variance, which is, again, the difference in price from what they were expecting compared to what actually the cost was. And the formula for this is the actual price less the standard price, and you take that and you multiply it by the actual quantity purchased. So actual price was $10,880, and you divide that by the 3,400 pounds, and that gives you $3.20 per pound. So we didn't know exactly how many it was at the beginning, but we easily figured it out by, again, taking the price divided by the pounds, and these are the actual amounts, and that gives you $3.20. That was the actual price per pound. Then there's the standard price, which is what they typically expect. That's $3.30 per pound. And then the actual quantity purchase, we already know that, 3,400 pounds. So now to be able to figure out the material price variance, we take the actual price less the standard price, so $3.20 less $3.30, multiply it by $3,400, and that gives you negative $340, which is actually favorable. And so let's think about that. This is favorable because the actual price per pound was less than the standard. And that makes sense. You look at this, $3.20 is less than the standard, $3.30, and $3.20 is less than $3.30. And because this is money that they're paying, not money that they're earning, it's favorable because they spent less money. Now let's talk about the material usage variance. This is a little bit different. The formula for this is you take the actual quantity used, subtract the standard quantity allowed, and you multiply it by the standard price. So we're trying to figure out if they used the right amount of material or if they used their material efficiently. So let's go down here. Standard quantity allowed was the 2,000 brackets multiplied by 1.5 pounds, so 3,000 pounds. So that's how much they are typically expecting to use to make 2,000 brackets is 3,000 pounds. Then we go to add the actual quantity used, and that was 3,080 pounds to create 2,000 brackets. So we compare the amount of pounds that they used to the amount of pounds that was typically allowed, multiply that by the standard price, and that gives us 3,080 less 3,000 multiplied by $3.30, or 80 pounds multiplied by $3.30, and that gives us a $264 unfavorable variance. And that's because, again, they spent more. And that's unfavorable because they actually used more material than they were supposed to, than they are used to. So we can see the difference there. Material price variance, you're just comparing how much something actually cost compared to how much it was supposed to cost as far as the actual quantity that was purchased. And then the material usage, it can also be called the material efficiency variance sometimes. That one is trying to see if they used too much or too little of the materials that they typically use to create something. So again, those are two different kinds of variances we learned in this one question. Now let's go to the next question to learn some more. All right, here we are at question 2. Again, reading the last sentence first. What are the labor rate variance and labor efficiency variance for May? So it's fairly similar as far as rate and efficiency, but now we're talking about labor instead of material. Bright Clean Services provides residential cleaning. The company sets a standard of 1.5 labor hours per home at a rate of $20 per hour. In May, Bright Clean cleaned 600 homes. The company paid $18,050 for 950 hours of labor. So again, what is the labor rate variance and the labor efficiency variance for May? Now, based on what we learned in the first question, you might be able to kind of think your way through this if you take what you learned about the material variances and apply it here. So if you want to give that a try, that's great. If not, that's okay. We're going to use the explanation to, again, learn how to do these variances. All right, here we are. The answer is A. There was a $950 favorable rate variance and a $1,000 unfavorable efficiency variance. So these are fairly similar, just we're talking about labor now instead of material. So let's go through this. First, we're going to talk about the labor rate variance. The way to do this is you take the actual rate less the standard rate and you multiply it by the actual hours worked. And again, you'll notice that's fairly similar to the material price variance calculation. So to figure out the actual rate, we take the $18,050 that it cost, divide it by the 950 hours, and that gives you $19 per hour. The standard rate is $20 per hour, and then the actual hours was 950 hours. So $19 per hour was the actual rate, less the $20 standard rate. That gives you a negative $1 multiplied by the 950 hours, and that gives you a $950 favorable variance. And that's favorable because, again, it took them 950 less hours than it typically does. And that's a good thing because it cost them $950 less than they were expecting, than the standard. Because, again, the actual rate was less than the standard rate. Now let's talk about labor efficiency variance. And again, this is somewhat similar to the material efficiency variance. The actual hours less the standard hours allowed multiplied by the standard rate. So standard hours allowed is 600 homes multiplied by 1.5 would be 900 hours. So that's the typical amount of hours that they are expecting. The actual hours was 950 hours, and we know that from doing the labor rate variance as well. So 950 hours, that was the actual, less than 900 hours, and that was the expected amount. Multiply that by the typical rate of $20, and that gives a $1,000 unfavorable variance. So more time was spent than expected, so it's an unfavorable variance. So you'll notice here that they don't have to be exactly the same. It doesn't have to be unfavorable and unfavorable or favorable and favorable. They're affected by different things. So the labor efficiency can be unfavorable, but the labor rate can be favorable. But just to make sure that's clear, again, the reason that the labor efficiency variance is unfavorable is because they spent more hours than they were expecting to spend to do the typical, 600 homes. So with that, we learned a couple more variance calculations. Now let's go to the next question to learn some more. All right, here we are at question 3. What are the variable overhead spending variance and variable overhead efficiency variance for July? So probably fairly similar as far as spending and efficiency, maybe very similar calculations, but with different things, different numbers. Let's go up to the top. Lakeview Furniture applies variable overhead based on direct labor hours. The standard variable overhead rate is $7 per labor hour, and each chair is expected to require 1.2 hours of labor. Okay, so they make chairs. Lakeview Furniture makes chairs. In July, the company produced 3,000 chairs using 3,800 labor hours and incurred $25,280 in variable overhead costs. So again, we're trying to figure out what the variable overhead spending variance is and the variable overhead efficiency variance is. Now, based on what you've learned from the first two questions, you might be starting to get an idea of the difference between, a spending variance or a pricing variance and an efficiency or usage variance. So I would encourage you to pause, take what you've learned, and try to apply it to this and give it your best shot. When you're ready, come back, we'll look at the answer together and learn more about these different variance calculations. All right, here we are at the answer C, $1,320 favorable spending variance and a $1,400 unfavorable efficiency variance. So let's go through this Now, to be able to see all of this very easily, let's just scroll down a little bit so we can see mainly the explanation. Okay, so first let's talk about what variable overhead variances help us to know, what they help assess. They help assess two things: whether the company paid more or less per hour than expected, and so that's the spending variance. And again, you can kind of apply that to the other types of variances we've talked about, similar idea. And it also helps assess whether the company used more or fewer hours than expected for its output, and that's an efficiency variance. Okay, now let's talk about calculating the variable overhead spending variance. The formula for that is the actual rate for variable overhead less the standard rate, and you multiply that by the actual hours. And in this case, again, that's the direct labor hours. So the actual variable overhead rate is $25,280 divided by 3,800 hours, and that gives you $6 or $6.6526 per hour. And by the way, sometimes exams are like that. Sometimes the exam question will say, which one is closest, but other times it will not say that, and you probably don't want to round things because you might get things slightly off if you round too much. And so you'll kind of see that throughout this video. Sometimes we round, sometimes we don't, and usually the question will say that. So in this case, we're not rounding. So $6.6526 per hour, that is the actual variable overhead rate. Compare that to the standard rate of $7 per hour, and we use the actual hours, and we can do the spending variance calculation. $6.6526 less $7 gives you negative $0.3474 multiplied by 3,800 hours, and yet that gives you a negative $1,320 favorable variance. And that variance is favorable because the actual overhead cost per hour was less than budgeted. So that makes sense, again, because this cost per hour is less than the $7, so it's going to be negative, but in this case, it's favorable because that means that they spent less money per hour for the variable overhead. So the spending variance here is a favorable spending variance. Now let's talk about variable overhead efficiency variance. The formula for this is the actual hours less the standard hours allowed multiplied by the standard rate. So standard hours allowed, we figure that out by taking the chairs, the 3,000 chairs, multiplied by 1.2 hours, that's 3,600 hours. That's how many hours they're expecting the 3,000 chairs to take, the 3,600 hours to make 3,000 chairs. The actual hours was 3,800 hours, and the standard rate is $7 per hour. So the efficiency is going to be the 3,800 actual hours less the 3,600 expected or budgeted hours multiplied by the $7 per hour, and that gives you 200 multiplied by $7 gives you $1,400. And that's an unfavorable variance because, again, they spent $1,400 more than they were expecting because it took them 200 hours more than they were planning on it taking to make 3,000 chairs. So you'll see it's very similar across these different variance calculations. You just need to know how to apply it in different situations. And again, usually if it's like spending or price variance or things like that, you're comparing the actual rate to the standard rate multiplied by the actual hours or the actual, some kind of actual amount. But then when you do an efficiency variance or a usage variance, you're comparing the actual hours or amount used to the standard hours or amount that is supposed to be used, and you multiply it by the standard rate. So again, you can kind of start seeing this pattern that we've noticed throughout these questions so far. With that, now let's go to the next question. All right, here we are at question 4. What are the fixed overhead spending variance and the fixed overhead volume variance for September? Let's go up to the top. Vista Lighting manufactures custom light fixtures. The company applies fixed manufacturing overhead based on expected production of 10,000 units per month. Total monthly budgeted fixed overhead is $150,000, and the standard fixed overhead rate is $15 per hour. In September, Vista produced 9,200 units and incurred $152,000 in actual fixed overhead costs. So again, we have to figure out what the fixed overhead spending variance and the fixed overhead volume variance is for September. Again, based on everything we've learned so far, I think that you could apply the idea behind everything we've learned in the other questions to this question. So I want you to pause this, give it your best shot, and remember the differences that we talked about. Try your best, and when you're ready, come back. We'll look at the answer together and learn about some more variance calculations. All right, here we are. The answer is A, $2,000 unfavorable spending variance and a $12,000 unfavorable volume variance. So let's go through this. First, let's talk about the fixed overhead spending variance. Fixed overhead, to calculate this, we just compare the actual fixed overhead to the budgeted fixed overhead. So fairly simple. The actual was $152,000, and that was told to us. The budgeted was $150,000. So they spent $2,000 more than they were expecting. So that is an unfavorable variance. They spent more than they were expecting. Now let's talk about the fixed overhead volume variance. To do this, you'd take the actual production less the budgeted production, and you multiply it by the standard fixed overhead rate. So again, very similar to what we've seen in the other questions. So the actual units that were produced was 9,200. The budgeted units was 10,000, so they did 800 units less. Now let's do the calculation. You take this standard fixed overhead rate of $15 per unit and multiply it by that difference. They did 800 less units than they were budgeted to do. Multiply that by 15 and that gives you $12,000, but it's an unfavorable variance because they lost $12,000. They made $12,000 less of product and also with an additional $2,000 of overhead cost as well. And the reason that that's unfavorable is because the company produced fewer units than planned, so fixed costs were spread over fewer units. So the fixed costs, they spent more than they were expecting, and they made less units than they were expecting to make. And so those costs are across less items. So this one is a little bit different than the variable because the fixed amount doesn't change. It's $15 per unit. That's how it is. But it's unfavorable in this case because they made less units than they were budgeted to make. So they are 800 short of what they wanted. So that's why it's a $12,000 unfavorable variance. Now with that, we learned again a bit more about some different variances. Let's go to the next question. All right, here we are at question 5. What are the selling price variance and sales volume variance for quarter 2? Let's go up to the top. Northwind Coffee Roasters budgets to sell 8,000 bags of coffee per quarter at a standard price of $15 per bag with a standard contribution margin of $6 per bag. In quarter 2, Northwind actually sold 7,200 bags at an average price of $16 per bag. So again, what are the selling price variance and sales volume variance for quarter 2? Take everything you've learned, think about this, pause the video, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is D, $7,200 favorable selling price variance and a $4,800 unfavorable sales volume variance. So let's dive into this. Again, it's going to be very similar to what we've talked about so far. You're just applying it in slightly different ways or in slightly different circumstances. So let's scroll down a little bit just to see the explanation a little bit better. It teaches about the sales related variances. So first, let's talk about selling price variance. You take the actual price less the budgeted price and you multiply by the actual quantity sold. The actual price was $16 and it tells us per bag. The budgeted price was $15 per bag, and then the actual quantity was 7,200 units or 7,200 bags. So you take the actual, which was 16, less the $15 standard or budgeted price, and you multiply it by the actual amount of bags that were sold, and that gives you $7,200. And that is a favorable variance because they charged more per bag than expected. And you don't want to get caught up here in the fact that they sold less units than they had budgeted because we're only talking about the price here. Again, what we see here for the selling price variance is that they had a favorable variance because for the amount that they sold each one for $1 more than they were budgeting. So this one is a positive or a favorable variance. Now let's go to the sales volume variance. This one is the actual quantity that was sold versus or less the budgeted quantity, and you multiply that by the standard contribution margin. So we take the actual, which was 7,200 bags. The budget was 8,000 bags. So they sold 800 less bags than they were expecting. And the contribution margin is $6 per bag. So 7,200 less 8,000 multiplied by $6 per bag, or again, that's negative 800 multiplied by $6, and that gives you negative $4,800. And that is a $4,800 unfavorable variance because they sold fewer bags than planned, which would reduce overall contribution margin. And so that's an unfavorable variance. So you'll see the difference here. When it comes to the price, they sold the bags for more than they were expecting. So it's a favorable variance. But in the end, they actually sold less bags than they had budgeted. So their contribution margin or their sales volume variance is actually unfavorable because, again, they sold less bags than they were planning to sell. So with that, you can kind of see, again, the pattern is continuing. Now let's go to the next question. All right, here we are at question 6. What are the flexible budget variance and volume variance for quarter 1? Let's go to the top. BrightPath Tutoring budgets 4,000 tutoring sessions per quarter with an expected variable cost of $25 per session and fixed costs of $60,000 per quarter. In quarter 1, BrightPath completed 3,500 sessions and actual total costs were $156,000. So what is the flexible budget variance and the volume variance for quarter 1? So think about this. Think about what we've learned in the other questions. Give it a try, pause the video, and when you're ready, come back. We'll look at the answer together. All right, here we are at the answer. A, 8,500 unfavorable flexible budget variance and a 12,500 unfavorable volume variance. So again, this is going to be fairly similar to some of the stuff we've seen so far. So first, let's talk about the flexible budget variance. The formula for this is you take the actual costs less the flexible budget, and that was at the actual activity. So variable cost was 3,500 sessions, multiply that by the $25, and that gives you $87,500. The fixed costs were $60,000, and so flexible budget was $147,500, and that's the variable costs plus the fixed costs. The actual cost was $156,000. So $156,000 less $147,500, and that is an $8,500 unfavorable variance because they were over their flexible budget by $8,500. So the fixed costs weren't going to change, but the flexible budget portion did change because they only had 3,500 sessions compared to the 4,000 that they were planning on. Now we go to the volume variance, and this has a lot to do with the flexible versus the master budget. The formula here is you take the flexible budget less the master budget, and we already know what the flexible budget is. We calculated that up above, so we need to figure out what the master budget is, and the master budget is just basically the standard, what they were expecting. 4,000 tutoring sessions at $25, and then you add the fixed costs, and so it's $160,000, and compare that to the flexible budget of $147,500, and that's $12,500 difference. And the reason that that's unfavorable is actually because it's less because they had fewer sessions than they were expecting. When it comes to a volume variance, if you have less than you're expecting, then that variance is actually unfavorable because they wanted to be up at 160,000 because that hopefully would have meant that they would have had 4,000 sessions or more than that maybe. And so that's a $12,500 unfavorable variance. So with that, now let's go to the next question. All right, here we are at question 7. What is the amount of overapplied or underapplied overhead for the year? Let's go up to the top. Capstone Cabinets applies manufacturing overhead based on machine hours. The predetermined overhead rate is $12 per machine hour based on expected usage of 25,000 machine hours for the year. In the current year, Capstone actually used 24,000 machine hours and incurred 283,000 in actual overhead costs. So again, what is the amount of overapplied or underapplied overhead for the year? So this is a little bit different than what we've seen before. You have to think about, did they overapply? Did they pay too much overhead, or did they not pay enough overhead? Based on everything we've learned in the other questions, I think you have a decent shot at figuring this out. So pause the video, think through this, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is D, $5,000 overapplied. So let's walk through this. It's not too difficult. You take the applied overhead, which is $12 multiplied by the 24,000 machine hours, so $288,000. The actual overhead was $283,000. So they were expecting, based on 24,000 machine hours, to have 288,000 applied overhead, but the actual overhead was 283,000. So that $5,000 difference means that they had $5,000 extra or overapplied for those 24,000 machine hours. They applied more overhead for the 24,000 machine hours worth of production than they were expecting or than was typically going to be applied. So with that, we've learned a lot about variance analysis in this video, and we learned a ton of different calculations for it, but they're all fairly similar. They all kind of follow along the same lines. Now, before we do anything else, let's do one more part of the SuperfastCPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up or that seem really important. You've seen multiple questions trying to teach you about the different kinds of variance analysis, such as maybe applying or calculating material efficiency variances or things like that. Again, these are the things that you notice throughout the questions as you're going through your review course. So you take a moment and you write these out in your own words, or you write out the key equations as pillar topics. And as you do this each day, you are building your own personal repository of the most important things you need to know for the exam so that you are ready when it comes to test day. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. For this video, because it was so calculation heavy and we learned a lot of different equations, mainly the pillar topics that's what it's going to be about this time. So you might want to take a second and write these down or make sure that you understand and see the things that are similar between them, because I think that's something that's very helpful. That is something that definitely helped me when I was preparing for the exam, is noticing the similarities between these different types of variances and realizing that as long as you understand a couple different kinds of variances, efficiency versus spending or price versus efficiency or usage or something like that, then you'll know, whatever the situation is, what kind of calculation you need to do. So let's go through this. First, let's talk about direct material variances. First, there's price variance, and you do that by taking the actual price less the standard price and multiplying it by the actual quantity purchased. Then there's the usage or efficiency variance for direct materials, and that's the actual quantity used less the standard quantity typically allowed, and you multiply that by the standard price. And again, you'll be seeing that kind of same idea throughout the rest of these. Let's talk about direct labor variances. For a rate variance, you take the actual rate less the standard rate, and you multiply by the actual hours worked. For the efficiency variance for direct labor, you take the actual hours worked less the standard hours allowed, and you multiply it by the standard rate. Now let's talk about the variable overhead variances. There's the spending variance for variable overhead, and that's the actual rate of overhead less the standard rate for overhead multiplied by the actual hours. And then there's the efficiency variance, which is the actual hours less the standard hours allowed multiplied by the standard rate. I'm sure you're seeing the pattern here. Now let's talk about fixed overhead variances. There's the spending variance, which is in this case just the actual fixed overhead less the budgeted fixed overhead. So that one's not too difficult. And then there's the volume variance, which was the actual production less the budgeted production multiplied by the standard fixed overhead rate. Now let's talk about the selling price and sales volume variances, very similar to what we've seen before. Selling price variance is the actual price less the budgeted price multiplied by the actual units sold. The sales volume variance is the actual units less the budgeted units multiplied by the standard contribution margin per unit. Now let's talk about flexible budget variance. And by the way, flexible budget variance and master budget and things like that, those seem to be a little bit smaller. So really what you need to know for that is you take the actual costs less the flexible budget, and that's based on actual activity. And remember, the flexible budget was taking the variable overhead plus the fixed overhead, and then you compare that to the actual costs. And then there was the volume or activity variance, and that was again the flexible budget less the master budget. So kind of similar, those two kind of fit together pretty well. Now, again, those were the pillar topics. Those were the main things that we needed to learn from this video. And that is the end of the YouTube version of this video. We only went over 7 questions for variance analysis, but SuperfastCPA Pro members are going to get access to the full 14 question video when we post it in the member forum. So they're going to get even more help and even more practice with these variance calculations. So if you like this and you like our other videos, if you've seen the other sections, then make sure you check out becoming a SuperfastCPA Pro member. And the easiest way to do that is by actually first going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, you're going to want to learn more. So again, that is a great path to learning about and becoming a SuperfastCPA Pro member. And they get access to these full versions of the videos. Now, this was the first bar video. I hope this was helpful. If you liked it, make sure to like it and leave a comment, and I will see you in the next video.